Alright guys, Chapter 10, Cross-Channel Issues, Advertising in Retirement Investing. Does anyone read Chapter 10? I appreciate the honesty. Alright? Okay. Chapter 10 gets a little complicated just in terms of it covers a lot of information. Okay, topics covered. Advertising. Almost all firms engage in some form of advertising, but ads for mutual funds or any kind of investment firms are heavily regulated. Okay? Let's talk about that for a second. When we see commercials for any kind of investment firm, what do they look like?
I don't think so.
Very dull.
Very dull. What do they show?
Most of the time, the logo of the company.
The logo of the company. What else? Do they show investment performance information?
No.
Do they advertise a specific product?
No.
No. This is due to advertisement regulation. Some regulation is really good. This is a good regulation. At least I believe this. Why? Because you don't want to advertise a specific mutual fund and say, in 2007, it got a return of 30%. Right? Is it true?
Yeah.
Could be true, but it implies something else, right? So they're heavily regulated, and to Pierre's point, they often show a lot of symbolism instead of certain fund information, right? They're actually restricted to give a lot of fund information because of these regulations. I'm not going to go too heavily into detail in terms of specific regulations. In 1933 this happened, but it's important to have a good grasp on what this is. Retirement savings, large influx in retirement savings over the last 25 years. Why has there been a big influx in retirement savings in the last 25 years? Is it because people all of a sudden decided retirement's good?
Social Security can't make it anymore.
Social Security can't make it anymore. Pensions are disappearing. And they're being replaced with what? Individual retirement accounts, 401k plans. Okay? The difference between individual retirement accounts and defined contribution accounts will be discussed. Marketing and distribution activities, how does it affect the industry? We've already covered a lot of the marketing and distribution side of stuff. So, mutual fund advertising. They advertise to stimulate sales. So they'll often advertise a brand, like iShares. iShares is very popular ETF provider, and they'll do a lot of advertising. They might do like one Super Bowl ad, or if you're watching like MSNBC or CNN, you might see an advertisement for another ETF provider. Why would they have? This is kind of a trivia question. Why would they have an iShares advertisement on MSNBC or CNN?
There's money.
Well, of course. But why those channels?
People watching.
What kind of people?
People watching news. Old people.
People who watch news. Who watches the news?
Why don't I have cable?
Smart people.
Older folks.
Maybe older folks, right? Watching MSNBC.
Not really older folks, because I still watch news all the time. I'm not that old.
But investment people, right? Investment people, people who are interested in learning about retirement information, people interested in getting educated about this stuff. They place ads everywhere. Ads in print, television, radio, the internet. Mutual fund advertising is heavily regulated. The Securities Act of 1933 regulated the offering and sale of securities to the public. So, I'm talking about like the IPO stuff, right? Required mutual funds to give a prospectus. It basically put a leash on investment managers, basically saying that you have to define your product. Like, this is what you're selling. Here, give us, the information on what it is, and you have to operate within these guidelines that you set for yourself. It's kind of like you're making sure you got what you paid for, right? Some of the stuff in this made advertising difficult as well. In 1955, Rule 134 was enacted, making it easier to advertise. And it says, please reference figure 10.1. That's in the books. Okay. Firms are allowed to include descriptive general information. Right? Not allowed to show or represent performance. Still, not allowed to show or represent performance. Why? Why do you think so?
creates a biased view.
A biased view, right?
Yeah.
We don't know. You know, the commercial is like a static piece of information. If you watch that one commercial, 3 years later, the performance in that commercial that they advertised might no longer be accurate representation of the performance, right? Must show how potential investors can obtain a prospectus. So they always give information about where you can go to get more information, right? They have to give you as much information as possible. Rule 135A, a lot of firms create non-fund specific ads. This did not require a prospectus. So some of the ads where you're talking about, where you see, some kind of symbolism for like a certain investment manager, if they don't talk about a specific fund, they don't have to. They can just advertise their brand, which is really important.
Let's speak generally.
Yeah, iShares is the biggest ETF provider in the world. So when they do advertisements, they do generally brand advertisements. They want you to explore their wide variety of ETFs. Basically, they'll say, that any kind of ETF you want, we can provide it. Rule 482, a lot of firms are finally advertise their performance with an omitting prospectus. And you guys can reference the book on that one. In the 1980s, regulations were tightened to prevent misleading performance. Makes sense. During the bubble of the 90s, there was unusually high performance in funds. Okay? Funds have to be careful as to not cite those years as normal. Right? So when they advertise, right, that would be a perfect example of what not to do. When you have really high performance, you don't want to just say, oh my, during a 10-year period in the 90s, we outperformed the market by 15%. Well, it was easy to outperform the market in the 90s. You could just overweight technology, and you would make money, right? All fund advertising must be reviewed by the SEC or NASD, National. I can't remember. Anyone know what NASD stands for? It popped off my head. Security. I think it's National Association of Security Dealers. By 1998, firms spent over $50 million a year on advertising. Downturns in the economy have reduced ad spending. Why? When the economy goes down, why does ad spending go down?
Because they charge clients for advertisement.
It's simpler than that, and this is not a quiz question. The first person to go in layoffs are usually marketing people, right? What do they cut back on? They're not going to cut down on the product development people right away. The first people to go are usually the marketing people, or the marketing departments. Yeah, they cut marketing budgets first, right? Television ads for funds are effective at advertising a brand, as we just talked about. Okay. Individual retirement accounts. This is important to know. The Employee Income Security Act of 1974, aka ERISA. You guys should be familiar with ERISA. If I ask you a question on what is ERISA, what does ERISA stand for, why does ERISA exist, you guys should be able to answer any of those questions for a quiz next week. ERISA gave way to the formation of individual retirement accounts. We have the traditional IRA. Okay, traditional IRA. Now I won't focus on the contributions a year, because they adjust those contributions, every few years. They raise them generally, right? Maximum contribution of $3,000 a year, tax deferred. Okay? That means that you can invest, let's not focus on dollar amount. You can invest a portion of your income, tax deferred, until retirement. So that means I can take money from my paycheck, theoretically, and put it in an IRA, a traditional IRA account. And that money that I put in that account, it bypasses the government. I don't have to pay taxes on it, right?
Lowers your taxable income too.
Lowers your taxable income until retirement. And then upon retirement, when you take that money out, it's taxable at whatever your tax rate is when you take it out, right? What's that?
Or just go R&D and roll it to a Roth.
Okay, so SEP IRA, I'm not going to focus on that, it's a little obscure. Simple IRA, same thing, it's a little obscure. The other IRA that I want you guys to focus on, did you have a question?
You have to get into the SEP IRA.
I have to.
And SERP plan, please define that for me, because I had a hard time at national distance.
I'm gonna have to come back to you on that
All right.
one. Sorry. I mean, basically, you want something more detailed than what's on the board, and I'm not prepared to give you that explanation today. I'm not going to BS you on it. I said BS on live camera. Was that embarrassing? All right. But I'll bring a detailed information line for you next class. So as far as what's up here, employees can make a maximum contribution of $9,000 that the employer matches. I don't know the details.
Maximum contribution is 5,000.
For what?
Traditional IRA.
Well, that's why I said not to focus on the dollar amounts, because when this book was published, where I based the slides off of, it was 3,000. But thank you for correcting me. I actually don't like to put the dollar amounts here, and so the book we used to use, the maximum amount was like 1,700. Because the book was from like the early 90s.
They increase them every year.
Yeah, they increase every year. So the Roth IRA, the important thing to note here is the difference between the traditional IRA and the Roth IRA. The Roth IRA is basically the reverse of the traditional IRA. Okay? There's a portion of your what? There's a portion of your income. What?
Don't pay attention.
Okay. Talking to yourself. All right. You can devote a portion of your income to the Roth IRA, and the Roth IRA works like this. I take money that has already been taxed out of my bank account, and I put it in the Roth IRA. And upon retirement, I won't be taxed on that money. The beauty of this is that I'm not taxed on any of my gains either. So I can invest and then make all the, hopefully, right?
You're not taxed on your gains?
Make all this money, and it comes out tax-free. So that's the advantage of the Roth IRA. But you get taxed on it up front, out of your income.
Yeah.
So you open up a Roth IRA and you just contribute to that, regularly, and then guess what? It's money when you retire. You don't have to pay taxes on it. That's the advantage of the Roth IRA. There's contribution limits though. That's why, let's just say it's $3,000 or $5,000 a year. Not someone like a fat cat can't just like dump all his money in a Roth IRA and invest and then take it all out. That's why there's fairly low limits on the Roth IRA to prevent, not fraud, but to prevent the wealthy from taking advantage of that kind of stuff. I will probably most definitely ask you what's the difference between the Roth and the traditional IRA. Okay? All earnings. So contributions are not tax deferred. However, all earnings are, which is a pretty good deal. However, I don't think as many people invest in Roth IRAs as they should. It's a long time. 30 years, 20 years is a long time to wait for that tax deferred money. But you can do really well on it. Why was ERISA created? Another question I'm most likely to ask on next week's quiz. To ensure corporations are funded and funded their pension plans adequately, to create a guarantee corporation to protect employees when their pensions were not adequately funded, to increase benefits that employees actually received by encouraging greater participation and faster vesting. What do I mean by vesting?
The individual would take all the money.
So, for example, my company offers. You're correct. So, for example, my company offers a 5-year vesting plan that steps up. So they match my 401k. But if I leave after the first year, they only that full amount they matched isn't really effective. They'll only really match 20%. The second year they'll match 40%. In reality, the third year they're matching 60%. On paper they're matching dollar for dollar. In my account they're matching dollar for dollar. However, I leave, they kind of claw back the difference between those two amounts. Does that make sense?
Mm-hmm.
Okay. Define contribution plans. Okay. The most common DC plan is a 401k plan. Now there's other similar type plans that 403b and what did you say? 409As. But 401k is the primary retirement vehicle that probably most of us will be involved with. Has a plan sponsor. The employee is referred to as the plan sponsor. Pretty straightforward. If I ask you who's the plan sponsor in a 401k, should be able to tell me that. The plan sponsor will determine the participant investment options. This is a really important piece of information. So the plan sponsor, your company, determines what options you have to invest in for your 401k. Most people's 401k have an option about 10 or 15 different funds to invest in, right? But I believe legally they're only obligated to give you 3 options.
And it has to be a stable value fund as well.
Yeah, a stable value fund, money market fund, and an equity fund. Or as a bond fund, an equity fund, and a money market fund. But nobody, virtually no one only gives you 3 options, right? Because that probably isn't the best. That would be a bad benefit plan, right? The participant is the employee, who is also the beneficiary. You're the one receiving the benefit. The plan sponsor is only acting as an intermediary, right? As a side note, the fiduciary duty is owed to the participant, not the plan sponsor. So what do I mean by fiduciary duty? Do you guys know what that word means? What phrase?
Isn't that like the representative?
Yeah, they're supposed to act, the final benefit is supposed to be to you, the plan participant, not the plan sponsor, right? So, this generally would not happen. But let's say there was some kind of financial incentive that they could offer, right? They're not going to offer, they shouldn't offer the plan sponsor this financial benefit, whether it's like some kind of rebate or kickback, right? That should be offered to the participants, because that's who they owe the fiduciary duty to, right? Not the plan sponsor. I have an interesting topic that I'll have off camera that just reminded me of something happened today. Participant will have a selection of investments to choose from. So pretty straightforward. Your employee has a relationship with the investment management or multiple investment management companies. They decide on a set of investment vehicles for you to choose from. You pick the investment vehicles. A lot of times now you'll see a lot of target retirement funds, like there'll be a 2040, a 2045, a 2050. What's that?
They start doing that now.
Yeah, it's fairly...
Before that, it was just like you choose large caps, small caps.
It's fairly recent. It's supposed to kind of dumb down the process for you guys,
Yeah.
right? So that way, if you don't know what to invest in, this is what you do. If you have no idea what to invest in for your 401k and you just want to simplify it for yourself, look for target date funds, right? And match it up with the year you want to retire in. So let's say I plan on retiring in 2045, right? I will look for a target date fund. They'll say like Vanguard Target Date Fund 2045. That means every year or every 6 months, depending on the portfolio will rebalance itself to match my generic risk profile. So as I get older, that 2045 target retirement fund will go to less and less risky investments. You know? But right now, the 2045 target retirement fund is probably going to be fairly on the riskier side, right? So as you get older, it changes. So that's a popular option in a lot of 401k plans. Okay. The record keeper sets up an account for each participant. Okay. Contributes and withdraws money for the participants and records their activity. This is a lot of stuff they do at State Street. You know, when we talk about big financial companies in the area, this is a lot of the stuff they do. They can get complex with transactions such as employee, pre- and post-tax contributions, rollovers, all that kind of stuff. Investment provider, the firm providing the investment selection, right? Pretty straightforward. A plan can have multiple investment providers. Some record keepers are also investment providers. I had a little misspelling there. So State Street, another good example. They can be the record keeper and the investment provider, right? And they can have other investment providers. Regulators. The primary regulator for the U.S. pension plan is the U.S. Department of Labor. They oversee the provisions of ERISA. Plans submit a series of DOL reports to verify compliance with regulation. DOL reports to the Department of Labor. Test for biases and discrimination, right? Making sure that everything in your plan is fair and accurate. And they don't mean bias and discrimination like we're not giving a certain investment to a certain ethnicity. You know, it means it's just biases in the plan itself. We talked about target retirement funds, right? If we had a target retirement fund, we'd want to have a variety of target retirement funds. We wouldn't just offer a 2050 target retirement fund, because that would actually be a biased fund, right? We'd have to have a series of target retirement funds. Okay. Additional information: fund companies have to sell on 2 levels. This is actually pretty interesting. They have to sell it to the plan sponsor, your company, right? But once they sell it to your company to make it be an option for you to invest in, you have no obligation as an individual retirement participant to actually pick that fund, right? And it's better for that company that their fund is at least an option. But they have to make sure that, you want to buy their fund. If you have 15 different options, you have to, you want them to buy your fund, so they have to sell that to you. So a lot of times what they'll do is they'll have somebody from that investment management firm come down to your work and do like an educational thing, which is valid, but it's also a sales pitch to invest in their specific products, right? Even my company, we're an investment manager. We have somebody once a year who comes down to basically sell us or educate us on financial products, maybe both, right? Fund managers want to have record keepers have their fund in their offering, right? So the record keeper is also an important door to get into, right? When we talk about record keeper, we're talking about like custodian banks, stuff like that. So if your fund has their records kept by State Street, you might be able to get your fund sold with State Street's other funds with another company. So there's a lot of piggybacking in this industry in terms of getting on a platform. Right now, the company I'm working for is trying to get one of our funds on Vanguard's platform. Why? Because Vanguard, if we get one of our funds licensed and branded by Vanguard, like we're still the investment manager, but it's now like the Acadian Vanguard fund. That will have a lot more eyeballs on our fund, which will naturally create a higher flow of income into the fund, which, as we know, that's how we make money, is based on a percentage of assets. So the more assets we have in the fund, the better. Okay. Large investment firms will offer free in-house record keeping if they use their funds. There's a correlation between the rise of mutual funds and retirement savings. We've talked about that before. Managing money is not the true goal of the firm, it's gathering assets, right? So, in my firm, we have some funds that are very high fees. We're an active manager, so naturally, we're going to have higher fees than any passive manager out there, right? But we also have some new funds that have lower fees that are supposed to target a broader base of the market. Now, we wouldn't want somebody to leave their high fee fund and go into one of the low fee funds, but we'd like to target new customers to go into our lower fee funds, just because now they have a relationship with our company and we're getting a percentage of those assets, right? So it's just about building that asset base. And the funny thing about building that asset base is it's also cyclical based on the economy too. So in 2008, if the stock market dropped 37%, guess what their fees dropped? Probably about by the same, right? Advertising has increased, but at what cost or benefit to the shareholders? And we could do a whole study on that, and no one would ever, we can determine if there was a true cost or added value to the advertising. Performance advertising is usually the most effective, right? Money talks, right? If your fund has positive performance, it's going to get more action, right, than a fund that has negative performance. We talked about that. Historical performance doesn't necessarily indicate that you're going to do better in the future, but people like to see good historical results. In the investment management business, the 3-year number, and I've probably said this before, is the gold standard. Everyone wants to know what your 3-year number is. Your 3-year number is the most relevant number, because it's showing a relatively moderate history on the performance, right? And now, since I work in the industry, that's what I look at now. I don't look at the 1-month numbers, even though that's the first thing off to the left that you see. It'll usually be like 1 month, 3 month, 6 months, year to date, then 1 year, 2 year, 3 year, whatever. I always look at the 3-year numbers. The 3-year numbers tend to be the most indicative of of the fund itself. Right. That's it for that chapter. So let's just do a quick review. I'll show off the video and I'll tell my little story.